Welcome once again to today's section. Today we are going to look at one of the amazing standards. And then you'll be fine. The standard is IAS 8. Today we are going to look at IAS 8. We will call it accounting policies, changes in accounting estimates, and prior period errors. So now let's put it down. So IAS 8, sorry. IAS 8, we talk about accounting policies, changes in accounting estimates, and prior period errors. And then you find. So basically talks about three items. So what are they? That's accounting policy. Policies. Changes in accounting estimate. Accounting estimates and errors or prior period errors. So that is the standard of the day. And then you refine. Now let's go into detail. Basically, this standard, the objective of this standard is to describe a certain criteria in the selection of what the accounting policy by organizations and changes in accounting estimates, and then how to correct what prior period errors. So basically, that is the objective of this standard. So this standard talks about 4 items. So 4 items we must know right after this, then that is the end of the standard. So first, the standard talks about the first aspect is accounting policy. So selection of accounting policy. That's the first item we are going to look out for. The selection of what? Accounting policies. Good. Second aspect, changes in accounting policies. So changes in accounting policies. Then the next item is changes in accounting estimates. Then finally, correction of what? Prior period errors. So prior period errors. So we'll pick each of them and start tackling them. And then you will be fine. Now, IAS 8 basically tells us how to treat this item. So with IAS 8, first of all, it describes the basis of selecting an accounting policy. So it describes what? The basis of selecting the accounting policy. So like how, on what basis do entities select the accounting basis? Are you free to choose any accounting policy you like? On what basis do you select your accounting policy? So IAS 8, the first section describes the basis in which financial statement or the accounting policies must be selected. And the second aspect deals with the changes in the accounting policy. And then the third one, they will changes in accounting estimate. And finally, correction of what trial period errors, and then we are done with IAS 8. So first of all, let's start with a selection of accounting policy. That's the first section that we are going to look at for. So I'll break this section into 4. So I'll talk about the selection of accounting policy first. And when we are done, if I could take like 2 to 3 minutes, and then we come and pick each of them. The issue has to do with these 3. That's where the issue is. So if you don't understand anything IAS 8, not the changes in policy, how do you treat changes in accounting policy? How do you account for changes in accounting estimate? And how do you correct all the prior period errors? So that is it. Good. So now let's look at the selection of accounting policy. Are you free to select any accounting policy you like? On what basis do you select the accounting policy? Here, the standard prescribes a basis for the selection of accounting policy. Before that, let's define accounting policy. So let's define what accounting policy. So accounting policy refers to what? Or they are what? Specific rules, principles, convention, practice. So they are specific what? Rules, common principles. Practice. And conventions. So practices and what? Conventions that must be what? Applied or applied by an entity. In preparing and presenting what? Financial statements. So private entity in preparing, wow, and presenting financial statements. So basically, accounting policies are what? They are rules, so specific rules. Principles. So rules, principles, practices, conventions applied by an entity in preparing and presenting of what? The financial statement. That's what accounting policy. So basic. Now let's go to the basis of the selection. On what basis do you select the accounting policy? On what basis do you select the accounting policy? Now, it's a rule, it's specific principle. So, and there are many. Sometimes we have alternative policies that we can adopt. Go. So, for instance, we have cost model, we have evaluation model in the PPE measurements. So you can select any of this. On what basis do you select the accounting policy? Now that we know the definition or we know what accounting policies are, we can go ahead and then deal with how to select a policy. It's very topical issue, even though it's minor in our standards here. Now the IAS 8 requires an entity to select an accounting policy which is what? Appropriate and comply with what? The IFRS. So the basis for selecting the accounting policy, we have to select accounting policy to what the most appropriate. So not any accounting policy, but must be what appropriate. And comply. Wow, I like it. So the basis for selecting accounting policies are it must be appropriate, must be appropriate, and comply with the IFRSs. So with what IFRSs? That's the International Financial Reporting Standard. So select one. Accounting policies that are what appropriate, online whether it's appropriate, and comply with what the IFRSs. In a sense that, or to ensure that the financial statements or the information that we are providing are relevant. Financial statements are relevant to the decision needs of the user. Decision needs of the users. That's one. And lastly, the financial statements are reliable. So here we have to select appropriate accounting policies, and it must comply with the IFRSs to ensure that the financial statements are relevant to the decision needs of the user, and to also present a reliable presentation. Yes, and make the financial statement or the information provided more reliable, and make the information provided more reliable, and make the information provided more reliable. Sorry, come in. Good, more reliable. So that is a selection of the accounting policy. Basically, we are done with the first section. The selection of accounting policy has been done in a way that will be appropriate to the entity. So not just turn up and then you pick any accounting policy you feel like, or other banking, probably know how to understand that policy very well. So anytime that's the policy that you apply. It's like an auditor that knows how to audit inventory very well. He has specialized in inventory. So anytime you visit your premises, why your inventory? Anytime asking for inventory. Good. Now we are there. So select the account policy which will be appropriate and comply with the IFRS, that's the financial reporting standards, to ensure that the financial statement that we are prepared or the information that we are provided in the financial statements are relevant to the decision needs of the users, and make sure that the information that we are provided are more reliable. We are done with the first aspect of IAS. We are going to work with the second aspect. They are short like this. So now we are done with the first aspect. Let's go to the second section of the IAS 8. The second section is how to treat changes in accounting policy. So the next one we are going to look out for is what? Changes in accounting policy. How to treat changes in accounting policy. So that's the next aspect that we are going to do. Changes in accounting policy. So accounting policy. So how do you treat accounting policy? So basically, how do you treat changes in accounting policy? Now, before we go to the changes in accounting policy, we have to tackle the general rule. What's the general rule? What is the general principle? So general rule. The general rule says that accounting policy, once selected and then applied, must be consistent from time to time, or must be kept the same from time to time to enable what? Comparability. So the accounting policy should not be changed. It must be what? Kept the same from time to time to enable what? Comparability. To enable comparability. That is it. To enable comparability. So that is the general rule. So it means that it's not easy for you to change your policy. The policy that you selected, you have to make sure that they are what? The same. So it must be kept the same. So accounting policy must be kept the same from where? Time to time, or from period to period, to enable comparability. Now, when we were doing the conceptual framework, we stated that one of the qualitative characteristics was comparability. And we said that to enable comparability, there must be what? Consistency in the accounting policy. So that's the general rule. This accounting policy must be kept the same. For instance, 2017 and 2016. Now, the 2016, the policy that you are using, you've changed it for new to 2017. Now, the issue is once the policies have been changed and then the bases are not the same, so you cannot compare. So comparison becomes very difficult because the bases are not the same, and any conclusion you're going to come out from this comparison may be what? Invalid. Yes. Before you can compare something, make sure that you're of the same grounds or the same word basis. Good. So that's the general rule. I know that sometimes some of the policy must be what? Changed. There's a need for it, critical need for it. Good. So aside general rule, every general rule there's what? An exception. So I think that there's a rule in the house that if you eat, wash the bowls. You set the rule for the kids. Now, one of them is very terrible. Then you fed the kid. Then when you add that, you expect him to go and wash the bowl. So you have to change the policy. Now you have to wash the bowl for him or for her. So the old policy must be changed. So here there's what? A need for the change. So that is it. Now, the change of the accounting policy will be required or be allowed if the following two conditions are in place. So, condition for change in accounting policy. So, aside the general rule, when there's a need for change in accounting policy, then you are allowed. So, let's go look for the two conditions that requires for changing accounting policy, and then you are fine. So here we are saying that the accounting policies that you have selected for yourself, do not change it. But sometimes realize that there's a strong need for a change in the policy. The only period that the change will be allowed or the change will be permitted according to IAS. So the IAS permits a change in accounting policy if that change. So let me start by saying this: IAS permits or requires accounting policy to be changed. That means require. IAS 8 requires accounting policy to be changed if, so the conditions are, if one, the change is required by what? IFRS. If the change is required by what? IFRS. So if the change is required by what? IFRS. Good. So if the change is permitted or required by a standard, so by standard, then you are allowed to change the policy. How? So let's cite an example here. Now, you realize that the accounting policy for that of borrowing cost, that's the interest that incurred on construction of a qualifying asset. Before IAS 20, all borrowing costs were expensed. That's finance cost. All borrowing costs were expensed in a P&L. But after IAS 23, the borrowing costs are now, some of them are capitalized. Those are eligible for capitalization. So it means that to an entity where before IAS 23, you were expensing all your borrowing costs on qualifying assets. Since that after IAS 23, you have to change that policy from where? From the written off of the borrowing costs against P&L towards capitalization of the borrowing costs. So this change is permitted by what? Or required by IFRS. So that is it. So in simple quotes, you were using maybe standard one. There was a policy there that you are using. And now later on, they've revised it or they've changed it. And then maybe standard 2 have come out with a new policy that is a change in accounting policy. So it means that the principles that you were followed by standard 1 has been changed according to the new standard. That's the standard 2. They've changed your policy. Have you seen it? Good. So a clear example is the IAS 83 in the case of the borrowing cost, and they were fine. Now look out for the next one. The conditions are two. The conditions are two. So we'll look at the second conditions too. The second condition states that if the change will result in a reliable, in fact, if the change will result in a reliable and more relevant presentation. And what? More relevant presentation. That means you are allowed presentation of events or transactions. So these are the two conditions that IAS 8 will allow you to change your accounting policy. First, it is required by IFRS or required by standard, or the change will result in a reliable and more relevant presentation or accurate presentation. So you change the policy to suit or to comply with the even flow of your inventory, then this change is what? It will result in more relevant presentation. So this change will be allowed by the IFRS. So it's like formally, the policy is not allowing you to disclose or declare most of the relevant information, but the new policy that you want to adopt, it will help you to present your financial statement or the event and then the transaction will be reported more reliable or relevant. Such a change will be permitted by what? The IAS 8. How we get it? Good. Now let's look at what constitutes a change in accounting policy. So what will happen? So these are the change in accounting policy. Now we know. So in exams, if there's any scenario and they are looking for the condition, make your mind to these two conditions and then you are done. Now let's see. What constitutes a change in accounting policy? Or we would say that a change in accounting policy will occur if there has been a change or there's a change in the following. There's a change in the following. So change has occurred if you have changed the following. One, so change in what? Recognition. So change in recognition. So recognition. Two, change in what? Presentation. And then three, change in measurement. So change in what? Measurement. So anytime we change any of these, even one, there has been a change in what? Accounting policy. Let's talk about recognition. Recognition is talking about the elements of the financial statement. So it's talking about the elements that we saw in the conceptual and regulatory framework. That the elements are what? Real. They are what? Real items. So the elements. So anytime you move in between this, you've changed what? Accounting policy. So a certain transaction, formally, when they occur, you treat them as an expense. So expense, to be expensing it. Then, now, When the same transaction occur, you are saying now they are assets. Have you seen it? So you change the recognition of that transaction. That's a change in what? Accounting policy. So formerly, an item was recorded as revenue, but now it's no more revenue, it's a liability. Good. There's a change in what? Accounting policy. Formerly, the item was an expense or asset, but now it's what? Revenue. That's a change in what? Accounting policy. So that is a recognition. And a clear example is IAS 23. IAS what? 23, the borrowing cost. Some of the finance costs previously were expense, but after IAS 23, some of the finance costs are now capitalized as what? An assets. So that is it. So before IAS 23, all borrowing costs or all the finance costs have been expensed in the P&L. But now, after IAS 23, they are now what? Assets. So that is it. So that's what? Change in recognition. Normally, these two are twins. Anytime you change recognition, the presentation too will change. Yes. Anytime there's a change in recognition, the presentation too normally follows. Presentation, that's a classification. You've changed the way you classify that particular item. So for instance, now we'll deal with the classification. So formally, the item was classified among cost of sales. So let's take depreciation for instance. If formally you classify it under operating expenses, so operating what? Expenses. So depreciation classified there. That was your policy. But now you change it. Now you classify depreciation under what? Cost of sales. So cost of what? Sales. Depreciation is now classified under what? Cost of sales. So therefore, this will be changing what? Presentation. Formerly it was presented under operating expenses, but now presented under what? Cost of sales. So old and now, or let's say previous and now. So this is what? A change in what? Presentation. Then we can also go back to IAS 23 again, the borrowing cost. The finance cost, previously, it was classified under finance cost in the P&L, or it was expense in the P&L. So expense in the P&L, that's the previous, before IAS 23 came to being. Now after IAS 23, now the finance costs, some of them, we are now going to present it under what? Assets. So the classification, we classify it under assets, will be added to assets. So the classification has will change, that's the presentation. So that is it. So now we know. Good. Now let's see. The last one talks about measurements. Measurements, that was the estimating the value of the transaction and event. How to determine the value and the transaction value of the transaction and event. Good. Now with this, let's take inventory. The measurement of inventory, the cost formulas. Formerly, you were using what? FIFO. But now, that's the previous. But now you want to use the weighted average cost approach. That's now. You change what? An accounting policy, because the measurement basis has been changed. Or you can also move from cost model to what? Revaluation model under IAS 16. But you can also move from cost model to fair value model under IAS 40. So anytime you change the measurement basis, you change what? An accounting policy. So that is it. Good. So now let's look at the accounting treatment. That's the most important section. The accounting word treatment. The accounting treatment. So take note of the accounting treatment. So anytime you change your accounting policy, how do you treat the change in the book or the change in your books or the financial statements? And then you are out fine. But before I look at the change in accounting policy, I'll cite two examples and tell whether they are changing accounting policy. So two examples. So two examples. I'll write them here. Now the first example is what? The application of accounting policy for transactions and events that differ in substance from those previously occurring. So, like, there's a transaction, but this time around, the transaction is different. So you decided to select what? A different accounting policy or a new accounting policy. So let it be, I wanted to change the accounting policy, but the answer is no. So anytime the transaction change and you adopt a new policy, it is not a change in accounting policy. Change simply means there was something running, going, and then all of a sudden you say, no, let me change. Here, I change the policy. But if you start something new, a new transaction comes with a new policy, no change in accounting policy. How do you get it? So for those who don't economics, they'll tell that change is what? New, and it's what? Previous. Good. So when you don't have previous, zero, the previous is zero, then that means it's not like any change. That's a new movement, right? Good. So that's the first question. Good. The same point, I can extend it. What if previously these transactions were occurring, but they are what? Immaterial. So previously the same transaction occurred, but they were what? Immaterial. But this time they are material. So I decided to adopt a new policy. Now, because previously they were immaterial, doesn't that there were no transaction. So therefore, it's no accounting policy, no change in accounting policy. We are done. Now let's go to the accounting treatment. Let's go to the accounting treatment, and then you are fine. The accounting treatment of changing accounting policy. So accounting treatment. So accounting treatment. A bit straightforward. So first, now when we change the accounting policy, we have to treat the change as if the new policy has always been there or has been in existence always. So that is the underlying concept. So treat the new policy or account for the change as if the new policy has always been there. So it means that we have to apply the change retrospectively. So then 2010, 2009, 2008. Now, assume that in 2009 we changed our policy. The question is, we have to assume that this new policy that we are applying, In fact, it was in 2008 or 2007. Yes. So apply the change retrospectively. So that is the accounting treatment. That's the basis for the accounting treatment. So that is the basis for what the accounting treatment. So first, the change should be applied retrospectively. So we need to do what we call retrospective application. So the change must be applied retrospectively. That is, what do you mean by retrospectively? It means that we have to just adjust the open balance, of the retained earnings. Open balance of what? The retained earnings. The retained earnings. In a statement of what? Changes in equity. In a statement of changes in equity. So we can add that one to it. In the statement of changes in equity. So adjust the open balance of the retained earnings in the statement of changes in equity. No shortcut. No shortcut. So that is it. Good. Now, what do we mean by and that's the open balance? So we said that apply the change as if the new policy has always been there. So let's assume our example. Let's start from 2005, 2006, 2007, 2008, 2009, and 2010, 2011. In 2009, if I change our accounting policy towards valuation or the recognition of certain transactions. So the issue is this: we have to apply the new policy as if this new policy has always been there. So you have to go back. Now the trouble is we can't go and pick 2005 financial statements and make the amendment there. No, we can't do that. We've already published that financial statement. It's in circulation already. In fact, we can't even find a way about all of this. So what can we do? But we know that it was their balances that we have carried forward in today's books, right? Okay, for the current period, we can make the changes. But for the previous years, making the changes is so difficult. What do you do? Then let's bring the open balances and let us not affect it. So that's why we bring the open balance of the retained earnings, open balance as at the beginning of what? 2009. So as at 2009, the balance brought down of the retained earnings so much. Then you adjust it. You adjust it with the effect of the change on the prior period. So from the date that you change your policy to previously, on the previous years, what will be the effect? Put the cumulative effect together and apply it on the open balance of the retained earnings, and then you are fine. How we get it? So that is the retrospective application that we are talking about. We are not saying go and pick the 2008 financial statement and adjust it. Just bring the open balance and then adjust the open balance. You are safe. Because we are saying that this new policy must be treated as if it has always been there. So we have to go back and then make the adjustment. So that is it. Have you seen the treatment? That's the first treatment that we are going to do. And then second, comparative information must be what? Restated. Comparative what? Information must be restated. So comparative information must be restated. That's the second accounting treatment. In fact, treatments are only two. So two. comparative information must be restated. Now, what do you mean by comparative information? The issue is this. Now, because we have changed the accounting policy, the current year you won't have issue, but the previous year. So, for instance, in our example, we changed the policy in 2009. So the 2009 financial statement we are going to prepare using what? The new policy. That's the good news. Now, when we want to compare this performance to that of 2008, there'll be trouble, right? Yes, 2008, there'll be trouble because the policy in 2008 has been changed in 2009. So what do? Then, meanwhile, the 2008 financial statement has already been prepared and published because we are in 2009. Okay, then for that one, then we can make amendments. So let's go. And then the financial statement that we have prepared for 2008, let's prepare it again using what? The new policy. And let's call it what? For comparison purposes. So that's what we call comparative information for comparison. Because the actual 2008 financial statement has already been published and then they're using it already. So for comparison purposes, let's prepare a new financial statement or let's adjust 2008 financial statements with the effect. So for comparison, so comparative. So prepare. So that is the comparative information must be restated. So anytime you are accounting for the change in accounting policy, then comparative information must be provided or restated. That is it. Now, the second issue has to do with the retrospective application. Now, assuming that the change in accounting policy after applying all reasonable efforts, you cannot apply the change retrospectively. What do? Then apply the change perspective all the way. So sometimes retrospective application is what? Impracticable to do so. Yes. So we have circumstances where the retrospective application might no longer be applied or will not hold. So that is it. So in that situation, what do? Meaning, if the open balance of the retained earnings cannot be reasonably determined, or the adjustment on this open balance cannot be reasonably determined, then the changes must be applied or adjusted prospectively. That's included in the current period or the current financial statement. Then you are done. Good. So we are saying that what if you adjusting the open balance of the retained earning is not possible? Why? Yes, we can ask you what are the circumstances that will not be possible for you to adjust the open balance. For instance, the new policy that you have adopted has no bearing on the previous period. Meaning the new policy that you've adopted in 2009, 2008, let's say 2007, the new policy you've adopted here has no effect. The effect is what? Zero. Or you cannot determine the effect reasonably on the previous years. So the impact on 2008 cannot be determined. 2007 cannot be determined. So if you cannot determine the impact on the previous year, then keep quiet and then apply it from the current period onwards. How we get it? So from the current period onwards. So that's the exception to the general rule. So even though we have to go back and make changes, if these changes cannot be determined reasonably, then what do? Apply the new policy from the current year and then onwards. From the current year going. That is it. For the nice question on that I put together, then you have to try and then do justice on it for me, and then you'll be fine. So that is the change in the accounting policy. We are done. Now let's go to accounting estimate. So we are done with the change in accounting policy. Now, please take note in the question solving stage. So can be part of the question solving stage. This space is for tutorials. So we are just explaining the issues or the principles. The practice will come when you are solving questions. So kindly join us when we are solving the questions, and then you'll be fine. Good. So now we are done with what? Change in accounting policy. All what we have to do is what constitutes a change? Is the change permitted by the standard or as by the IAS 8? And then in event of impracticable, to apply the change with respect to what do? You have to apply the change or perspective all the way. So that is it. Good. Now let's go to the next item. The next item on the list. Now the next item is the accounting estimate. That's the next item on the list. Accounting what? Estimate. Accounting estimates. So for accounting estimates, we will first define what an accounting estimates are. Then from there, we look at changes in accounting estimates, and then we go to errors. And we are done with IAS. What level to what? Illustration questions. Illustration questions. So now estimates. So accounting estimates. So accounting estimates. Good. Now, with the accounting estimates, you don't need to worry at all. The definition. So clear. Now, estimate is very topical issue because most of the items in the financial statement are estimates. Yes, most of them are estimates. Because at the time they are preparing the financial statement, not all of them have been materialized. Or take the tax, take the deferred tax provision, all of these are estimates, but including the current year tax and estimates. Good. In fact, depreciation is an estimate. So most of these items that we report in the financial statement are what? Estimates. So the question is, what is an accounting estimate? An accounting estimate is the method adopted by an entity to arrive at the estimated amount in the financial statement. Good. So that is it. This, I'm not the one saying this. This one is coming from where? The standard. So the standard define an estimate at what? The method or the process of what? Estimating figures and amount in the financial statement. That's the what? The definition for estimate. So accounting estimate is the process of what? Estimating what? Figures and amounts in the financial statement. Simple. We are done. Now, a clear distinction must be drawn between estimate and policy. Good. Take this opportunity to clear the difference. Accounting policy and accounting estimate. What's the difference? Good. Now, policy deals with specific rule, specific practice, specific principle. But estimate deals with what? Determining unknown figure. So any figure or any item that the amount or the value involved is not actual, but it must be forecast or determined through a degree of what? Estimation. That is what an estimate. In fact, I've not said anything. Let me give you an example. Now, To depreciate assets, that one is what? To depreciate assets, that one is an accounting policy. So some organizations, okay, let's depreciate. So depreciation, to charge for depreciation is an accounting word policy. Some organization does not depreciate their assets. Some also depreciate their assets. That one is a matter of what? Policy. But the method of depreciation, that becomes what? An estimate. Have you seen? So the choice to depreciate an asset is a policy. So this one becomes a policy. Then the method becomes what? An estimate. Why? Because we are going to estimate for in value. Anytime you are estimating an unknown amount or determine unknown amount, like you've been asked to tell us the marks that you are going to score in exams. If I should tell you, or if I should ask you that, please tell me the marks that you are going to score in exam, it's unknown. So such an amount must be estimated. How to get it? Good. So that's an estimate. But if I should tell you that, okay, how are you going to write the exam? If I ask you, how are you going to prepare and write the exams? Okay. This examination, in fact, for this examination, I will do, let's say, 4 papers. I will write 4 papers and study well. Probably that will be a policy to you. But to tell me that these 4 papers that I'm going to write, I will score 59, 67, 70, and 55 respectively. Now you can determine how to get. Even after the exams, when they give you chance, you can estimate the actual marks that you want to get. So that is it. Now the issue is this: sometimes the decision to run something is a policy, but if that amount, so the decision to write ICA is a policy. Why is it that we have ACCA, we have ICA, we have CIMA, we have ACIB, but you selected what? ACCA or ICA or CIMA or ACIB? That is a policy. But to determine the marks or to determine the completion year is an estimate. Yes. To determine the completion year, the year that you're going to complete, an estimate because unknown. Good. Now let's bring it to business environment. So some of the examples of accounting policies, they are: 1, the measurement of assets, that's PPE. At a point in time, we have to select, or we have the 2 models, we have to select one. So cost model, have you seen? And go and select another one. You choose a different policy. That's the revaluation model. And the IAS 16. And the IAS 40, we still have cost model and fair value model. So all these ones are policy. However, if you pick the cost model and you are going to estimate the value, you are going to estimate the depreciation. I'm saying I've changed the table. When I said what? We have to select between one of these policies, and then we have to what? Now estimate the depreciation or the current amount of the assets. So that's the difference between accounting, estimate, and policy. So anytime they've asked you to determine some figure, and that figure, you know that it's unknown, do a guesswork. That's an estimate. Good. But policies are specific rules or principles that you have adopted for yourself. Good. Now, we know accounting estimate. So let's look for changing accounting estimate, the accounting treatment. So change in accounting estimate. The accounting treatment. In fact, for accounting policy, the change must be applied retrospectively. For change in accounting estimate, it must be applied or prospective all the way, so prospectively. So that's the good news. So the change must be what? The change must be applied prospective all the way. Just that a change in accounting estimate is an adjustment of the carrying amount of an asset or liability or the amount of the product consumption of an asset. So that is so basically we are moving around what depreciation. So good. Now, most of the figures in the financial statement require some estimates or some estimation. The exercise of judgment based on the latest information available at that time. So we have to take note of that. So the change must be applied for or must be accounted for in what? In the financial statements prospectively. So here we said that prospective adjustments. Prospective, not retrospective. For accounting policy, retrospective. So if you have 2009, the change will go back. For accounting policy, no. Sorry, for accounting estimate, no. Accounting estimate don't go back. You only go front. So that's the prospective all the way. The prospective all the way. Prospective all the way. So the period of change and then the future periods. So here the new estimates. The new estimate must be what? Applied in the period of what? Change and the future periods. So the new estimate must be applied. Must be applied in the current year, and the future periods too, if it will affect both the future periods as well. Good. So that's the accounting treatment. So here we don't need to go back. We don't adjust the retained earnings. No, we don't need to adjust the retained earnings. So we have to just apply the new estimates. Here, if care is not taken, you tell the examiner that apply the new policy. You are estimate. So the new estimate must be applied in a current year or the current period, and the future periods as well, if it affects both. Sometimes the new estimate affects only the current year. That means apply it only to the current year, no future periods. If it affects both, then apply it both, and then you are done. So now let's see some of the examples of changing what accounting estimates. Changing accounting estimates. So examples of changing accounting estimate are examples of changing accounting estimates. Here we don't do retrospective application, and because of that, we don't need to restate the comparative information. So first, examples. Now depreciation. Everything about depreciation is an estimate except the cost. Let's use the straight line method. Depreciation is equal to, is equal to the cost less what? The residual value or the stock divided by half years, right? Good. But everything over here. So first, change in the method of depreciation. Change in the following. Change in one, method of depreciation. So method of depreciation. Two, change in the residual value. So residual. In fact, this residual value, we normally call it what? Estimated residual value. Yes, it is estimated. It's not actual. Then three, the estimated useful life of the asset. So useful life of the assets. Four, change in provisions. Then including bad debts and then any other, because provisions are liability of uncertain time and amount. So if you change any of these items, amount for account for changes in accounting estimates, and then you are done. And then changes in estimated amount of what? Bad debts. So that's a provision for bad debts, and then this part. So we are done. Now I want to project a question, and then you try your hands next. So when I break a question, kindly pause the video, work it out yourself, and then you will continue the video later. If you pause, very good for you. Now let's see. Let's look at this example. Now it reads, which of the following is change in accounting policy as opposed to a change in estimation technique? One, an entity has previously charged interest incurred in connection with the construction of tangible non-current assets to the estate of profit and loss. Following the revision of IAS 23 in accordance with the revised requirements of that standard, it now capitalized these interests or capitalizes these interests. That's the first one. So is it a change in accounting policy, or is just a change in accounting estimates? Good. So here, in fact, there has been a change in what? Recognition. Formerly, it was expense in the P&L previously, but now they capitalize it, meaning they treat it as an asset. So recognition has also changed. And once recognition change, presentation also change. So now they will present it among the assets, no more an expense. So that is a change in accounting policy. That's good. Now let's move on. Two, an entity previously depreciated by using reducing balance method at 40% per annum. It now